Look, you could beat 90% of all retail traders and investors if you pick one thing to beat them on. In today's world, value investing and that buy and hold strategy that Buffett evangelized is not working anymore. In today's video, we're gonna cover why that is and one strategy that you can pivot into in order to save your money and years of beating around the bush. So that being said, welcome to today's video and I'll see you on the screen. So this notion is titled 50% returns from a crappy company. And there's a reason why I titled that way, because we're gonna crystallize the difference between professional trading and value investing. But first, you need to know where you fall in between those two camps. We all know Warren Buffett, we all know his strategy, we all know his track record. He's one of the idols in the world of value investing. But here's something not many people know. Back in the day when Buffett got his start, he used to pick small companies that weren't covered by Wall Street, weren't in the news, information wasn't really out there for them, and he used to regard them as cigar butts, meaning not that good in quality, but they had one big puff left that he could squeeze that value out of. It wasn't until Charlie Munger came on the scene that he pivoted his investing strategy to wonderful companies at fair prices instead of fair companies at wonderful prices. So that big shift came with size, because back in the day, Warren Buffett had his first partnership valued around $100,000. And that partnership bought him a house for $31,500 with only 2 to 3 years of returns. Today, to buy a home, which the average value is $512,000, you need to make 20% on a fund that's valued at $2.5 million. So in order to raise $2.5 million, you basically need a hell of a track record in the stock market. And even to get there, you need to have a strategy and method, a systematic process that can be repeated year in, year out and outperform the market. Here's the problem by following the exact methods that Warren Buffett used to do. You see, the decline in turnover ratios for the stock market, which is basically volume divided by market cap, means one theme is happening across the entire market. Let me explain. So the turnover ratio slowdowns means that more people are buying and holding stocks and companies across the board. There's not that much trading in and out of companies anymore. And there's one big group of players that are driving this turnover ratio lower, such as BlackRock. If you see from 2000 up to 2023, 2024, they've grown their assets under management from a few billion to $10 trillion and over. So what's the problem here, right? You are now competing against giants like BlackRock, Goldman Sachs, JP Morgan, who take long activist positions in both public and private companies, not to mention real estate too. So when Buffett started off, ETFs and wealth managers were nearly unheard of, leaving you with an open field of nearly no competition when it came to value investing. Today, you're swimming in a Red Sea where information gets spread faster than ever before. This way, you can't really beat the game of value investing unless you have the size and the stomach. Because if you start looking at a company that represents opportunity, chances are that JP Morgan, BlackRock, and all these other big players are already activist investors in it, which means you don't really have an edge. And that information spread will erase all of the intrinsic value gap that you might find today. So the only way to beat it really is to go into smaller companies below 5 billion, 10 billion in market cap so that you have the informational advantage and these people can't touch them. But that comes with its own set of issues. So I think there's a better way that you can go about all this. Instead of being stuck in a casino for a long time, playing the house that literally owns it all, why not come into the highest probability game where you know you have a better chance than all the other players on the table, make money, go home, count it, and repeat the process. By this I mean, if you play the buy and hold game, you're essentially playing the lowest odd game in the casino, and the house knows this. If they can keep you playing for longer under those low odds, then chances are you're gonna lose all your money and they get to keep it all. So why not come in, look for the cold table in a game that has the better average odds for the average player, come in, get to know it better than anybody, make money, go home, and then come back the next day, right? So this is something that differentiates trading from investing. And if you see this picture here, not many people know that the guy on the left is one of the best traders out there, not considering the quant traders like Jim Simmons and all these other areas of trading, right? But that guy, he's a multi-billionaire that built his wealth in a fraction of the time compared to Buffett, not to mention at a much younger age. So Steve Cohen was best known for running Point72, which was a hedge fund that was focused on order flow trading and made its plays alongside with long short equity. Long short equity is a little known strategy in the market that could take up 2 to 3 hours in a video by itself. So we'll just get to a few results that we've managed to make money from using that method instead. But for those of you that are really serious about learning this and implementing it for yourself, we made a free 5-day email crash course, which we linked below this video. You can sign up for it after you finish this. And trust me, by day 5, everything you learn will place you ahead of 90% of all other traders. That being said, let's go over our example of a trade that didn't fit in the value investing industry, right? That is Intel. By most value investing standards, this company was a dog with fleas. I mean, look at this. We have declining market share. We have the company burning through cash, investing into the US fabs for chip making. We have negative earnings per share and free cash flow. We have compressing margins and CEO issues, which he left a few months ago. Not to mention the layoff that took place all over Intel. Yet, as a trader, I loved the setup this company gave me when I was screening inside the semiconductor industry. Let me explain. So, we have all the comps that I picked for the semiconductor industry, and you can see one crazy fact right here. The market back then, this is early August as far as the data goes, the market was pricing in Intel right along Nvidia, which is the king of semiconductors. You see, the forward PE was at 31.4, while Nvidia was at 32.4. So why is the market placing the two in the same quality factor, in the same growth factor? Even though Intel was set to grow its EPS by 350%, while Nvidia was only set to grow at 32%. I mean, this is 10 times as much growth with no quality in the financials, yet the market is still pricing in the same as quality and growth as Nvidia. It just doesn't make sense, right? And here's the thing. I don't know why the premium is there, nor do I need to. At the end of the day, someone knows something is up with Intel and obviously has better information than I do. So why would I fight the market on this, right? And notice that Intel was between $19 and $21 per share when I sent this text to our free WhatsApp group chat, which is also linked below the video if you want to check that out. We send out a lot of deals and a lot of ideas and discussions in there on a daily basis. So I did say, I don't need to know why the premium is there, nor do I need to, but it could be because of tariffs, a new CEO, or even a giant buying out Intel. Funny enough, those in the know were acting on this hypothetical privileged information already. So you see Pine Ridge Advisors, they bumped their position in Intel by 50.9%. And then you had Vidant Advisory bumping theirs by 22.4%. And only days later, we saw the news from the US government and Nvidia buying multi-million-dollar positions, or multi-billion, I should say, into Intel. So sending the stock higher roughly by 50% to 29 and over is no coincidence. You saw it happening, you saw the premiums going in, you saw the narrative, right? But as an investor, you would have completely ignored Intel or even started buying 2-3 years ago when the company was quote unquote decent, right? But you would have to wait all those years, go through all the volatility, go through all the uncertainty and the negative media around Intel. And that's just not what we want to be doing. We want to be where the action is, where the edge is. Now, this is the game you and other smaller players in the field have to start playing today. Long-term investing is obviously becoming a no-edge strategy, as we've seen through many metrics out there. Now, here's the true beauty of long-short equity, because you can't really just bet on these narratives that are speculative, right? You can't connect the dots, essentially as we did with Intel. You could say, well, there's a premium about the stock that we have to figure out why, but we don't really have to know why. We just need to connect the dots and figure out, okay, the market is willing to pay a premium for it. The market is expecting huge growth. Let's just go along with it, do a little digging and see if we can justify it. Even if we can, we still have to cover our butts in case we're wrong. And this is where the hedging aspect of long short equity comes in. So this is a tweet that I sent roughly around the same time that I was expecting Intel to go up. And here I was going long rocket companies and short Salesforce. So as I said, hedging is a fundamental part of long short equity. It can not only keep you uncorrelated to whatever the S&P 500 is doing, but it can also halve the volatility of your portfolio by default. Same upside, much less downside, and every trader wants that. I called for a long in RKT, as I told you, and a short in CRM on August 28th when the stock traded around $255 a share. September 4th, it fell down to $235. That's an 8% fall on a large cap stock within 1 week, on top of the 50% return we had on Intel. Here's a chart of CRM if you want to check it out, but I mean, it's pretty much self-explanatory at this point. And don't forget, we were also going long RKT at 17.5. That stock went up to 22 in less than a month, which is another 26% return. So how is this all possible? If you're going to be a value investor, you can really only do so in companies that these giants can touch. That means 5 to 10 billion in size maximum. Anything above that and you'll be in a world of pain. Trust me, as I explained before, they're going to drive the news cycle. They're going to drive all the policy for the company. They're going to drive a lot of things that you have no control over, because these giants are now becoming activists in all those companies. So instead, why not learn what is happening behind the scenes of hundreds of stocks and land yourself right where guys like Steve Cohen are hunting, guys who are just trying to eat what they kill, like yourself. Long short equity outperforms most market environments, but especially choppy ones. If you understand this chart, then you understand that the Mag 7 are going X growth, while the other 493 stocks in the market aren't pulling their weight when it comes to EPS growth either. Then you understand the all-time high valuations in the market will create a very choppy place to be invested in. I mean, as you see here, the Mag 7 are going from 22.8% growth in EPS to only 11.8% in the next quarter. At the same time, all the other 493 stocks are going from 2.6 to only 3.0. So riddle me this. If the biggest companies in the industry, in the market, are going down in growth, hence the X growth phase, and all the rest of the economy is delivering only 0.4% in growth, how can you justify the all-time high valuations in the market? That's where I mean. This is all going to become choppy, and there's one strategy that has outperformed choppy markets for centuries, and that is long short equity. So hopefully with this, you understand the difference between value investing, professional trading in the long short equity method, and why one is going out of business if you are a retail investor, and while the other one has all of the edge that you can have as long as you learn it. So I hope you got a lot of value out of this, and now you're beginning to understand why buying and holding is becoming harder every single day. You're playing a game that is changing completely, and now you must pivot where all the other players that don't have the size as BlackRock are going into, where the real returns are, where the real informational advantage is. And to me, that is long short equity. So again, if you are interested in this strategy, we're going to break it down for you over 5 days for free in an email crash course, which again, you can sign up for in the link below this video. And if you go through that and figure out, hey, this is something that I need to do for my money and for my portfolio, we also offer a one-on-one mentorship program called the Sovereign Trader. It's a 6-month program where by the end of it, you're going to be able to copy and paste everything I do on your own, and even monetize those ideas by selling them to other audiences that need high quality setups. And the supply of it, honestly, is not there, because everyone still relies on technical indicators and all the BS advice that is getting thrown around out there in the industry. So that being said, I hope you got a lot of value out of this, and I'll see you in the next one.